number that Wall Street's analysts actually believe, you will never watch an earnings announcement the same way again. The number that reflects everything they actually know right now. And their whisper said the number should have been higher is the mechanism behind one of the most consistently confusing experiences in retail investing. A company reports earnings, it beats the estimate, the stock drops 8%. If you have spent any time watching earnings season, you have seen this happen. Maybe it happened to a stock you owned. The headline said beat, the chart said sell, and nobody on the financial news explained why, because explaining it would require admitting something the industry would rather keep quiet. There are two numbers that exist for every earnings report. The one you can see, published by Bloomberg, FactSet, and every financial news outlet on the planet, and the one you cannot see, the number that Wall Street's analysts actually believe that circulates privately among traders and institutional investors before the reports drop, and that the stock price is actually measured against when the number comes in. The gap between those two numbers is called the whisper, and once you understand how it works, you will never watch an earnings announcement the same way again. Let's start with how the official consensus estimate is built, because the flaw is in the architecture. When a sell-side analyst wants to forecast a company's earnings per share, they build a model. According to a former UBS Warburg analyst, Peter Offerl, who described the process publicly in 1999, there are typically 20-plus page spreadsheets tracking every variable that affects company financials. Analysts update these models continuously as new information comes in. Channel checks, competitor results, economic data, supply channel signals, management commentary at conferences. Here is the structural problem. Every time the model updates, the analyst's true expectation changes, but they cannot publish a new research report every time the spreadsheet moves. Issuing formal revisions require compliance review, management sign-off, and distribution infrastructure. In practice, an analyst might update their internal model dozens of times in the weeks before a report, but their published estimate, the one that feeds the consensus, might not have moved in months. So, what happens when a client calls the analyst the week before earnings? The analyst tells them the real number, not the published number, the current model number, the number that reflects everything they actually know right now. Offerl described this directly. Analysts maintain updated internal estimates that diverge from the published numbers, and when a client calls them, they share their latest expectations. Those expectations then spread. Trader tells portfolio manager tells trading desk tells buy-side analyst at other funds, and within days, the true expectation has circulated across the professional investor community, while the retail investor sitting at home is still looking at the consensus estimate that hasn't moved since last quarter. That circulating number is the whisper. In 1999, researchers published a paper called Whisper Forecasts of Quarterly Earnings Per Share in the Journal of Accounting and Economics. It was the first serious academic examination of whether whisper numbers were real, where they came from, and whether they actually predicted stock reactions better than the official consensus. Their findings were unambiguous. Whisper numbers were more accurate than analyst consensus forecasts. They were a better proxy for the market's true earnings expectation. And critically, the stock market's reaction to the earnings announcements was already more accurately predicted by the whisper number than by the official consensus. A company beating the consensus while missing the whisper moved like a miss. A company beating the whisper moved like a genuine beat. The consensus was a decoy. The whisper was the real target. A Bloomberg study reinforced the accuracy gap with specific numbers. Whisper forecasts missed actual earnings reports by an average of 21%. The official published consensus estimates missed by an average of 44%. The unofficial number the one retail investors could not access was more than twice as accurate as the official one. The site earningswhisper.com, which has been collecting and publishing whisper numbers since 1998, now has a dataset of 117,000 whisper numbers spanning 25 years. Their data shows the whisper number has been closer to the actual earnings report than the consensus estimate 70% of the time. More importantly, since August 1998, stocks of companies that beat the whisper number closed higher by an average of 1.8%, and were up 60% of the time in the days after the report. Stocks that beat the consensus estimate but missed the whisper closed, however, 55% of the time. Beating the number everyone can see while missing the number no one can see produced a loss more often than a gain. A separate 2002 research report found that stocks beating the whisper had an average one-day gain of more than 2%. Stocks beating the consensus but missing the whisper gained approximately 0.1% on the first day of trading. That is nearly a 20-to-1 difference in reaction, driven entirely by which number the stock was measured against. Before we go further, there is a piece of regulatory history that makes this story more complicated. In August 2000, the SEC adopted Regulation Fair Disclosure, known as Reg FD. Before this rule existed, companies could legally brief individual analysts and institutional investors privately before making information public. A CEO could call their 10 biggest institutional shareholders before an earnings release and give them a preview. A CFO could confirm or deny guidance in a one-on-one meeting with the favored analyst. This was standard practice. The SEC chairman at the time, Arthur Levitt, described the practice in a speech as having utterly no place in a fair-minded, law-abiding economy. Reg FD was designed to end it. Under Reg FD, if a company intentionally discloses material non-public information to a market professional, it must simultaneously disclose the same information to the entire investing public. The rule was and remains a direct attempt to eliminate the informational advantage that institutional investors held over retail investors. After Reg FD took effect, academic research found that whisper numbers became less accurate than they had in the pre-FD period, consistent with the theory that some of the whisper's precision had come from private management communications. The playing field moved at least partially toward level. But here's what Reg FD could not fix. The analyst's model is still updating in real time. The published estimate is still stale. The gap between what an analyst truly believes and what they have formally published still exists, because the compliance and publication process cannot keep pace with the rate at which new information flows into a model. The analysts are still talking to their clients. Reg FD restricted what companies could say privately. It did not restrict what analysts could say to the people who pay the firm's fees. The whisper did not die with Reg FD. It evolved. Today, it is less likely to carry leaked management guidance. It is more likely to be the accumulated signal of every analyst's true current model, transmitted through the informal networks that predated any regulation that will outlast any that follows. Now, let's talk about what this means for how prices actually form. The official earnings consensus exists because markets need a shared benchmark. Without some published expectation, there is no way to define what a beat or a miss even means. But the consensus has a structural weakness baked into it. It is an average of estimates that were published at different points in time by analysts with different access to current information, and it moves slowly because publishing revisions is expensive and slow. The whisper exists because institutional money cannot afford to act on stale information. When a hedge fund is holding a position going into earnings, they need the best available estimate of what the number will be, not the average of what a dozen analysts thought 6 weeks ago. So they call in analysts, they aggregate the signals, they build their own proprietary view, and the collective result of thousands of professional investors doing the same information gathering process is the whisper, an emergent, distributed, continuously updated estimate that lives entirely outside the official data infrastructure. The retail investor who sees a headline saying earnings beat 5% and wonders why the stock is selling off is experiencing the gap between these two systems in real time. The stock is not reacting to the consensus, it is reacting to the whisper. And the whisper said the number should have been higher. Here's what to do with this. First, stop reading earnings headlines as binary. Beat and miss are relative terms. Relative to what number is the entire question. A beat against a stale, understated consensus during a period of strong business momentum is not the same event as a beat against an aggressively high consensus in a slowing environment. The sign of the number means nothing without the context of what the market actually expected. Second, sites like earningswhisper.com publish their collected whisper numbers publicly before earnings releases. This does not level the playing field entirely. The professional investor has better access, faster information, and larger analytical resources. but it means the whisper is no longer invisible to anyone willing to look for it. Third, understand what the post-earnings price reaction is actually measuring. In the first minutes after a report, the stock is not processing the absolute quality of the earnings. It is processing the surprise, the gap between what came and what was expected. If the whisper was already pricing in a strong beat and the beat was merely okay, the surprise is negative even if the headline is positive. This is why great companies can have great report numbers and sell off, and why struggling companies can report bad numbers and rally. The market is always trading the delta, not the level. The consensus estimate is the number they show you. The whisper is the number they trade on. And the distance between those two figures, invisible to most investors, documented in academic literature since 1999, and still active in every earnings season, is the mechanism behind one of the most consistently confusing experiences in retail investing. Now you know what it is. The question is whether you will use it.
Nice.
Sweet.
Nice.
Sweet.
I like it.
Sweet.
Nice.
Sweet.
Boom.
Sweet.